Hi everyone, how are you guys doing? So today I'll be going through 5 simple guidelines when I'm looking out for dividend growth companies to invest in. At the end of this video, you will learn how to evaluate dividend growth companies for yourself and learn how to create a long-term dividend growth portfolio that will generate you passive income over time. I will also highlight some red flags that will save you not only money, but also a lot of time and a lot of headache. So we have a lot of good stuff to get into, and I'm sure you will learn a ton of stuff if you stick around till the end of the video. And I'll have a surprise for you at the end of the video as well. But first, for those who are new here, welcome. And what you're looking right now is my personal portfolio, and it's based on an investing strategy called dividend growth investing. As the name suggests, I'm focused on investing in companies that will provide me with consistent and growing dividends. In this way, I'm earning passive income that I don't have to work for. So if you scroll down, and if you take a look at the amount of dividends that I've earned in the past year, I've earned around $320, so around $1 a day. Now this amount is certainly nothing to brag about, but this extra dollar I earn every day is something that I don't have to work for, and it pays for the morning coffee I have every day. The idea behind dividend growth investing is that I reinvest these dividends and consistently set aside some money I get from my monthly salary and allocate it into this portfolio you see here. So over time, the value of this portfolio will grow and the dividends will compound and grow even faster. And in the future, I'll be earning $5 a day, which pays for my lunch. Down the line, it grows to $20 a day, which pays for my monthly groceries, then to $100 a day, and so on and so forth, to a point where these dividends basically pays for my cost of living and with more to spare. Now, I would like to give you a quick portfolio update, and as you can see, I have a few companies that are in the red. This is of course due to the health issues surrounding the coronavirus, and it caused some concerns in the market. And if you look at the past 1 month, the portfolio actually dropped from $11,800 to around $11,600 in 1 month. So that's about a $200 decline, or a 1.6% decline in 1 month. To be honest, in terms of investing, I'm not too concerned about the coronavirus. I know that my companies in this portfolio will be able to survive this. Their stock prices may dip in the short term, which is great because I can purchase quality companies at a discount. And in the long term, they continue to pay me consistent and growing dividends. If I have any concerns about the coronavirus outbreak, it will be about the social and emotional impact, especially in a small country like Singapore. But from an investor point of view, it's concerning that some businesses has their entire supply chain in China. So if they are not able to get their resources from China, the whole manufacturing chain breaks down. So for example, Nissan had to shut down the Japan factory because of shortages in Chinese parts. So with supply issues, businesses will definitely be affected in the short term, but in the long term, this will be just a blip. So if you're like me and your portfolio has some red in them, don't worry, it's perfectly normal. The good news is there'll be some companies whose stock prices will be on a discount. So you can think of it like a Black Friday for stocks. So back to this video, I'll give you 5 guidelines that have served me well when picking dividend growth companies. So let me switch over to my notepad here. As you can see, there are 2 main categories. The first is qualitative and the second is quantitative. So for qualitative, we are concerned about how the business is doing based on pure facts, like its business model, its products or services. For quantitative, we are going to the numbers of the business, which means that we will look at the income statement, the balance sheet, and the cash flow of the business. The first qualitative thing to look at in the business will be its economic mode. Now, this is not something that I've invented. It's a term that is actually coined by Warren Buffett, one of the most successful investors. Let's hear what he has to say about the economic mode of a company.
But the most important thing what we're trying to do is we're trying to find a business with a wide and long-lasting moat around it, protecting a terrific economic castle.
Do you hear what he said? In essence, Warren Buffett is looking out for businesses that has a moat around it. The wider the moat, or the more crocodiles the moat has, the better. It prevents outside enemies from attacking the castle. In an investment sense, it prevents competitors from eroding the market share or eating into the profits of the company. So what kind of moats are we looking at? If it is a product or services company, the best moat to have is a strong brand. So I'll be seeing if the brand symbolizes something like quality, reliability, or something premium that consumers will appreciate. Also look at its offerings. I'll see whether the products will be relevant in the long term. Does the company's offerings have some form of stickiness to it? For example, once you purchase an iPhone from Apple, you'll want to get an Apple Watch and a Mac because they integrate so well with one another. So if it's a REIT or real estate investment trust, I will look into other things. When it comes to properties, location is everything. Are they near train stations or bus stops, or are they close to major roads or highway? I also look at the tenant, shoppers, and worker mix. Are there any tenants that are reputable and have signed a long-term lease? Are there high footfall from shoppers or workers that basically will make the property a very high traffic place to be at? Since REIT is a totally different ballgame, I'll probably do a separate video which will go into greater detail. Aside from the economic mode, I will also look at the management. Now, management is really important because it has a trickle-down effect on the rest of the business. The management will create the vision for the company, and I'll look at things such as, is the vision relevant and does it bring value to the market? The management will also determine the culture of the company, and I'll see how happy employees at work, the turnover rate. And this is important because if employees are happy, there's a very high chance customers will be happy as well, something that we want to see in a long-term company. So the last qualitative aspect that I'm looking out for is the experience and track record that the management has. I love a company with a long-term successful CEO that is able to lead a company. As a football fan, I always look at the CEO of a company like the manager or a coach of a sports team. He must be able to set the culture, lead its employees to fulfill its vision. Right, so qualitative speaking, we have covered the economic mode and the management. So we'll move on to the quantitative aspects. And by quantitative, I mean that we'll be looking into the company's numbers. Since this is a dividend growth portfolio, we are of course looking out for consistent and growing dividends. I went through why I look at dividends in my previous videos, but to sum it up briefly, consistent and growing dividends are a strong indicator that a company has a sustainable and resilient business model in the long term. So let's take a look at an example. So we are at Yahoo Finance, and Fraser Centrepoint Trust is a REIT, and it is one of my holdings in my dividend growth portfolio. So if you scroll down, we can have a look at its dividend yield. So for this particular company, it is at 4%. So the dividend yield is actually calculated by taking the amount of dividends in a year divided by the current stock price. So as you can see, the dividend yield may fluctuate depending on the current stock price. If the current stock price decreases, the dividend yield may increase even though the amount of dividends that we receive in a year may not change. So the dividend yield as a percentage is not a good indicator of whether the company pays out strong and consistent and growing dividends. Let's clear this out. And what we are actually interested in is the actual dividends paid out to shareholders. And there are a couple of ways to find out the actual dividends being paid out. The first way is to look at the official website. So to do that, let's head over to Google and let's type in the company's name. So in this case, let's look at Fraser Centrepoint Trust. And at the back, we include investor relations dividend. So let's have a look. And as you can see, the very first link we have here is the official website. Let's click into it. Now, most companies will have their financial result and distributions and financial calendar laid out in their website. And what we are looking out for is the distribution history or the dividend history. So this table showcases the dividends paid out to shareholders. And as you can see, the REIT started in 2006, and from quarter over quarter, from each year to the next, it has basically been increasing its dividend over time. So that is a really good sign, and that is what we are looking out for. And if you look at the total dividends in a year, it too has increased year over year. This is great, and this is what we should be looking out for. What I like to look at is to go even deeper. I like to look at the recession years and to see how did dividends actually perform. So in 08 and 09, we have the Great Recession, and as you can see, the REIT continued to increase its dividend. During big recessions like the one we had in 08 and 09, some companies may maintain their dividends or some may even cut it by a little bit, and that's fine. But the first red flag to note here is that when I see a company halving or stopping its dividends during times of crisis, I probably wouldn't invest in it. The reason for having a dividend growth portfolio is to earn passive income in good times and bad. So if I see companies stopping or drastically cutting its dividends, it's a big red flag for me. The second red flag is called the dividend yield trap. This means that investors are lured into buying a stock that simply has a high dividend yield, say between 6 to 15% or sometimes even more. They think that they are buying into a good dividend paying company, but in fact they are not. One example of this is StarHub, a Singapore telecommunications company, and currently they are having a dividend yield of 6%, which is pretty decent. In fact, they have a much higher dividend yield in the past. If we go to the chart page, and if we go out and see a longer timeline of things, you can see that the reason for this high dividend yield is that the stock price has been falling, and at the same time, dividends has been declining as well. It has been paying dividends of around 5 cents, and then it became 4 cents, and it became 2 cents. So even though the dividend yield is a respectable 6%, it's maintaining at this dividend yield because of the declining stock price and the declining dividend as well. So the learning point here is to always look at the actual dividends being paid out by the company. Now, after looking at the dividends, the next thing we would like to look at is the debt level. So what we want to see is that the company has manageable debt and not a sudden increase of debt just to pay its dividends. If the company has increasing revenue or profits, it's perfectly normal to see debt level increase by around 15 to 30% year over year. But what we don't want to see, the debt level doubling or in some cases tripling. So we'll look at another company in my holding, Sheng Siong Group. So this company is a Costco of Singapore. So they retail groceries at wallet-friendly prices. And to see the debt of the company, we'll look at its balance sheet. So let's scroll down here. And as you can see, there are two categories of debt. First is current liabilities. So current means that these liabilities that you see here has to be paid within 1 year. There's also non-current liabilities, which means that the amount that you see here will have to be paid back to lenders in a time frame longer than 1 year. So if we look under total liabilities, we don't want to see a sudden surge of debt. For example, the debt level doubling within 1 year. So we want to see manageable debt levels, which is present in this case. So it just increase gradually over time and is manageable for the company. Having manageable debt means that the company isn't taking out too much risk and is not using debt to pay its dividends. The last thing I look out for quantitatively is cash flow. Now, when it comes to growth, most people will look at the top line, which is the company's revenue, which you see here, and its bottom line, which is its net income, which we see here. But to me, the most important thing is actually cash flow, and it is under this tab here in Yahoo Finance. So more specifically, we are looking at the cash flow from operating activities, or CFO in short. So what is CFO in the first place? Investopedia defines it as the amount of money a company brings in from its ongoing regular business activities, such as manufacturing and selling goods or providing a service to its customers. So simply put, it is the amount of cash generated from a company's core business. Of course, we would like to see this number increasing. If it is increasing, it usually means that the company operations is growing and is generating cash for the business. So in this case, for Sheng Siong, let's have a look. So if we go to the cash flow table right here, and if you look at the cash flow from operating activities section, we see that the net cash provided from operating activities has been relatively increasing over the years. Then I'll look at the free cash flow, which is right below. So as you can see, there's also an upward trend, and the free cash flow tells us how much cash there is left over for a company to reinvest into the business or to raise dividends in the future. Of course, For free cash flow, the more the better, and also we are looking for an upward trend, which in the case of Sheng we are seeing one. So there we have it, a simple, easy to understand checklist when it comes to selecting dividend growth companies. Remember at the start I told you that there will be a surprise at the end? Well, this is it. I've come up with a nicer, better designed checklist which sum up all the points that is discussed today. Of course, every investor will have their own set of things they look out for, so feel free to add or remove points in this list as you go along. Personally, I find this list pretty helpful when creating my dividend growth portfolio because it really helps me to decide which companies to invest in and which companies to avoid. The link to this checklist is in the description box below, so feel free to click on the link to download it. As usual, I'll be posting updates and guides on my dividend growth portfolio, and to be honest, I'm interested in seeing how this portfolio performs during the turbulent time in the market. Of course, you're welcome to join me. As usual, if you enjoyed this video, hit the like button, subscribe, and I'll see you in the next one.